You're watching today's market comment by Mario Sechikiriakos here at XM.com. I'm Christina Marujos. Global markets are holding their breath in anticipation of today's U.S. CPI inflation release. The stakes are high as this data set will be critical in shaping expectations about the trajectory of interest rates. It could either cement the view that the Fed has already concluded its tightening cycle or bring this notion into doubt, driving the dollar and risk assets accordingly. In July, forecasts suggest both the headline and core CPI rose by 0.2% in monthly terms. On a yearly basis, that would translate into an increase in the headline CPI to 3.3%, while the core rate is projected to hold steady at 4.8%. As for any surprises, there is some scope for a hotter than expected CPI report given the signals from commodity prices, business surveys, and the housing market. Markets will likely react to a hot inflation report by pushing U.S. yields higher, which would be a blessing for the dollar, but a curse for assets such as stocks and gold that become less attractive as yields rise. On the flip side, colder than expected CPI readings could elicit the opposite responses, hurting the dollar while boosting equities and bullion. The Japanese yen has fallen victim to another selling wave, sinking to its lowest level since 2008 against the euro. It's been one-way traffic all week for the yen despite the nervous atmosphere in risk assets. At the core of the yen's troubles lie rising energy costs. Since Japan is a net importer of oil and gas, the yen absorbs damage through the trade channel when energy prices rise. Gold also encountered some heavy selling this week, but the CPI report will be the deciding factor for the precious metal, which tends to move in the opposite direction of the dollar in yields. Hence, a hot inflation report could push bullion lower, turning the spotlight on the crucial $1,900 region. Energy costs are going ballistic again. Oil prices are on the rise for a seventh consecutive week, hitting new multi-month highs in the process, while futures tracking European natural gas prices rose 28% yesterday amid concerns of supply disruptions. While the demand outlook remains bleak, it appears supply conditions have gotten so tight after a series of production cuts from Saudi Arabia and Russia that prices have managed to find support. Whether this trend persists will have repercussions not just for energy markets, but also for inflationary pressures and therefore riskier trades as well. Thank you for watching today's market comment here at XM.com.